Hello everyone, I'm Dr. Bryce, and welcome back to my channel. First off, I want to thank all our followers and subscribers for their incredible support. We've now reached 94,000 subscribers and counting. If you're new here, don't forget to click the bell button down below to join our family of finance enthusiasts and receive all our latest content. Today, we're diving into a topic that's been on many minds lately: real estate investment trusts, or REITs. This video has been highly requested. You remember, in one of my recent videos, I asked you guys if you wanted a deep dive into REITs, and the response was overwhelming yes. Now, as a quick disclaimer, while I am a real estate finance specialist, I'm here to provide general information on finance as it relates to the US economic environment. That's why it's important to research what's relevant to your specific country, situation, and seek local professional financial advice. All right, let's get started. I'm going to assume you have no prior knowledge about REITs, so we'll start with the basics and build up from there. Okay? Oh, by the way, I've timestamped everything in the description below, so feel free to jump to the sections that interest you most. And stay tuned for follow-up videos where we'll delve even deeper into the details. So, what exactly is a real estate investment trust, or REIT? Think of a REIT as a big pot where lots of people put their money together to invest in real estate. It's like everyone pitching in to buy a big toy that none of us could afford alone. At its simplest, a REIT is a company that owns, operates, or finances income-generating real estate. According to the U.S. Securities and Exchange Commission, SEC, REITs provide a way for individual investors to earn a share of the income produced through commercial real estate ownership. Now, let's dig a little deeper. In fact, REITs work similarly to mutual funds. You know, when you invest in a mutual fund, you're pooling your money with other investors to buy a diversified portfolio of stocks or bonds. Likewise, with REITs, you're pooling money to invest in a diversified portfolio of real estate assets. There are different types of REITs. First, we have equity REITs. These type of REITs companies own and manage income-producing properties. Their revenues come primarily from rents. Second, mortgage REITs. These provide financing for income-producing real estate by purchasing or originating mortgages and mortgage-backed securities. Their revenues are generated primarily by the interest they earn on the mortgage loans. And thirdly, hybrid REITs. These combine the investment strategies of equity REITs and mortgage REITs by investing in both properties and mortgages. According to the National Association of Real Estate Investment Trusts, as of 2021, approximately 80% of REITs are equity REITs. Now, you might be wondering, why should I invest in REITs? Great question. Here are some benefits. The first benefit is the accessibility. REITs allow individual investors to invest in large-scale, income-producing real estate without the need to directly buy properties. Secondly, we have diversification. By investing in REITs, you can diversify your investment portfolio, reducing overall risk. Thirdly, liquidity. Many REITs are publicly traded on major stock exchanges, making it easy to buy and sell shares. According to the Internal Revenue Service, IRS, to qualify as a REIT, a corporation must distribute at least 90% of its taxable income to shareholders annually.
Thank you, Dr. Bryce. I'll proceed from here. Now let's talk taxes. One of the significant advantages of REITs is their tax structure. Number 1, pass-through taxation. REITs are not subject to corporate income tax if they distribute at least 90% of their taxable income to shareholders. Number 2, dividends. For investors, dividends received from REITs are generally taxed at a lower rate compared to ordinary income. According to Dr. David Funk, a professor of real estate at Cornell University, REITs offer a tax-efficient way for investors to gain exposure to the real estate market. Now, let's explore two notable REIT companies that have shown strong performance and offer insights into different sectors of the real estate market. Firstly, Simon Property Group, or SPG. Simon Property Group is one of the largest retail REITs in the United States, specializing in shopping malls, premium outlets, and mixed-use properties. Here are key features. Market capitalization, approximately $120 billion. Portfolio, owns or has an interest in over 200 properties, including iconic shopping centers like the Mall of America. Tenant mix, partners with luxury brands such as Louis Vuitton, Prada, and Dolce & Gabbana. Simon Property Group has demonstrated resilience in the face of changing retail landscapes. Despite challenges from e-commerce, the company has maintained its position by focusing on high-quality properties and adapting to consumer preferences. In 2021, SPG showed a strong recovery from the pandemic-induced downturn, with its stock price rising significantly. Secondly, American Tower Corporation, AMT. American Tower is a leading REIT in the telecommunications infrastructure sector, showcasing how REITs can extend beyond traditional real estate. Key features: portfolio, approximately 219,000 communications sites globally, geographic diversity, significant presence in India, 75,000 cell towers, the US, 43,000, and Brazil, 23,000. American Tower has capitalized on the growing demand for wireless communication infrastructure. As 5G technology continues to roll out, the company is well-positioned to benefit from increased data usage and mobile traffic. Despite a slight dip in one-year returns, 0.59% as of the report date, AMT offers a dividend yield of 2.15% and has shown long-term growth potential. Let's look at REIT performance and investment considerations. When comparing potential returns, it's helpful to look at benchmarks. From 1972 to 2019, REITs, on average, returned an 11.8% total annual return compared to the S&P 500's 10.6%. This outperformance demonstrates the potential of REITs as a valuable addition to a diversified investment portfolio. Of course, let's not forget that no investment is without risks. With REITs, some of the risks include market risk. REIT share prices can fluctuate based on market conditions. Secondly, interest rate risk. Rising interest rates can make REIT dividends less attractive. And lastly, property-specific risk. The performance of a REIT can be affected by the specific properties it holds. That's why, when considering REIT investments, it's crucial to evaluate factors such as the company's portfolio quality, management team, financial health, and growth prospects. Additionally, understanding the specific real estate sector and its current market dynamics is essential for making informed investment decisions. As with any investment, it's advisable to consult with a financial advisor and conduct thorough research before adding REITs to your portfolio. The examples of Simon Property Group and American Tower Corporation illustrate the diverse opportunities available in the REIT market, but they also highlight the importance of selecting REITs that align with your investment goals and risk tolerance.
Thank you, Maya. All right, now let's test your knowledge with a quick quiz. Which of these is not an example of what REITs invest in? A. Apartment buildings. B. Office spaces. C. Superhero costumes. If you guessed C, superhero costumes, you're absolutely right. Yes, because while that would be pretty cool, REITs stick to real estate investments. All right, friends, we've learned a lot about REITs today. What they are, how they work, the different types, and the risks and rewards. Remember, investments can be exciting, and there's always more to learn. Okay, don't forget to hit the subscription button below to stay tuned for our next video. Keep exploring, stay curious, and invest smart.
Okay, let's go.